Welcome to Smart Wealth with Joshua.
Your daily stock analysis and catalysts talk. Today we're looking at CRCL.
If you find our talks useful, please consider subscribe, like, and comment underneath.
And before we get into today's stock, here is a useful tool for investors who want a faster and cleaner research workflow. You can check out stockanalysis.com Pro through the link below in the description. Use discount code ITP for 10% off. Stockanalysis.com is lightweight, fast, and works on desktop, iOS, and Android. The free version is useful for checking stock prices, financials, charts, forecasts, and news. But if you want deeper research, stockanalysis.com Pro gives you no ads, saved screeners, watch lists, portfolios, long-term financial history, dividend history, analyst filters, ETF data, and exports to Excel, CSV, and Google Sheets. Pro comes down to about $5.93 per month when billed annually after the discount. For heavier users, the unlimited plan adds unlimited downloads and unlimited stocks per watch list, and comes down to about $14.93 per month when billed annually after the discount. Stockanalysis.com is a research tool, not financial advice. It does not tell you what to buy or sell, and it does not guarantee investment results. Always do your own research and make your own investment decisions.
This is an affiliate link, so we may earn a commission if you use it at no extra cost to you.
So I want you to just imagine watching a single company process $33 trillion in transaction volume in just 1 year.
Which is just a staggering number to even wrap your head around.
Right. Like, to put that into perspective for you, that is significantly more than the entire gross domestic product of the United States.
The whole country.
Exactly. So you see a metric like that, and naturally you expect the company's equity to just be touching the sky.
Of course.
But then you pull up the stock chart for CRCL, and honestly, it looks like it stepped on a landmine.
It really does.
I mean, we are looking at a brutal 30% drop from its prior highs. Just a massive cliff.
It's a massive psychological reset, yeah. And look, if you are listening to this right now and you have a portfolio that has taken a hit like that, a 30% haircut is terrifying.
Oh, absolutely. It hurts.
It flushes out the weekends immediately. The market is testing some really severe downside resistance right now, and the fear out there is just palpable.
Yeah.
But, and this is where the disconnect becomes so fascinating, the underlying network adoption is absolutely exploding.
Exploding while the equity is literally being dumped.
Exactly.
And I mean, that is exactly why the retail market is so spooked right now. When you see a 5% plunge in a single trading session, which we literally just saw, the immediate question you have to ask yourself is, am I trying to catch a falling knife here?
Right, which is the classic fear.
Because buying into a chart that looks this broken, it just goes against every natural survival instinct an investor has, you know? Your default reaction is just to run.
Sure, but running right now might mean fundamentally misreading where we are in the adoption cycle.
How so?
Well, what you're seeing on that red stain chart, it's textbook disbelief phase behavior.
Okay, the disbelief phase.
Yeah. The market is entirely focused on short-term equity flows right now, and they're completely ignoring that $33 trillion volume tailwind that's actually pushing the business forward.
Which is a massive oversight.
Massive. A fundamental reality of that magnitude, it has to reconcile with the equity chart eventually. You could ignore network adoption for, a quarter or two, but you cannot ignore it when it starts reshaping global finance.
And if this technology is truly reshaping global finance, then we have to understand how it actually functions within a broader portfolio, right? Beyond just the panic of the current trading week.
Exactly.
All right, let's move into the wealth building context.
Because you really do have to look past the short-term price shock here. CRCL is not just another speculative crypto play.
Right. It's way beyond that now.
It is rapidly cementing itself as the primary gateway for the tokenization of global credit markets. Institutional capital is flooding into this space at a rate that is, honestly, hard to overstate.
The numbers on that institutional shift, they really are staggering when you actually dig into them.
Tell me about it.
Like, let's just look at private credit for a second.
Yeah.
Back in the first quarter of 2013, banks had about $8 billion committed to private credit vehicles. Fast forward to the fourth quarter of 2024, and that number has exploded to $95 billion.
Wow.
Right. But the crucial shift here isn't just the amount of money, it's the actual rails that the money is moving on.
Exactly. Capital is increasingly flowing through stablecoin rails rather than your legacy clearinghouses.
And you have to understand why institutions are actually making that switch.
Because it solves a huge problem.
Yes. The traditional banking system operates on a T+2 settlement cycle.
Which is painfully slow.
Painfully. That means if you move millions of dollars, it can take 2 full business days to actually settle and clear. And, plus, traditional banks close on weekends and holidays.
Right. You try wiring money at 5 p.m. on a Friday, and you're stuck until Monday.
Exactly. But stablecoin rails like Circle's USDC, they settle continuously, 24 hours a day, 7 days a week, in a matter of seconds with total transparency.
So when you look at this through a wealth-building lens, you really aren't buying a crypto token.
No, not at all.
You have to frame this as the foundational settlement layer for an entirely parallel financial system.
Yeah.
If you are structuring a multi-year growth portfolio, having exposure to the infrastructure that settles institutional credit globally, that is an essential consideration.
But for that thesis to really hold water, the company actually has to capture the value of that volume, right?
Right.
Now let's look at the fundamentals.
Because to really grasp the moat here, you have to break down how they actually generate revenue.
Let's do it.
The trajectory is exponential and is driven primarily by 2 mechanisms. First, there's the expanding adoption of the USDC stablecoin itself.
Okay.
And second, it's the interest income they earn on the reserve assets that are actually backing it.
Let's unpack that mechanism so it's crystal clear for you listening. When someone buys 1 USDC token, they give Circle 1 actual US dollar.
Right, a one-to-one exchange.
Exactly. Then Circle takes that dollar and puts it into yield-bearing assets like short-term US treasuries.
Yeah.
The user gets a digital token they can send instantly around the world, but Circle keeps the interest generated by that underlying dollar.
Which is genius.
And when you realize there are 89 million daily holding addresses, that is a massive pool of capital-generating yield.
It is. Just look at the Coinbase integration alone.
No, right.
The average USDC balances held just within Coinbase products hit $17.8 billion in 2025.
That's just one partner.
Just one. And because of the way the business is structured, the margin profile is incredibly healthy.
Because there's no physical product.
Exactly. The marginal cost to mint or burn a digital token is virtually zero. You aren't manufacturing anything.
Right.
So their subscription and services revenue, which includes that massive stablecoin yield and their blockchain infrastructure fees, is actually outperforming their transaction-based revenue.
It's basically a free cash flow machine.
Absolutely.
Okay, but I have to stop you there.
Sure.
Because the moat is where I naturally get cautious.
Fair enough.
Yes, they have scale right now, but what happens when the actual titans of traditional finance enter the arena?
The big banks.
Yeah, big banks. We are already seeing major players like SoFi and JP Morgan launching or developing their own stablecoins.
Right.
With their captive deposit bases and, massive regulatory muscle. Why wouldn't the big banks just crush Circle?
It's a common concern.
It feels like we might be looking at an AOL walled garden situation versus the open internet.
Okay, that analogy is actually perfect, but it proves exactly why the banks won't crush them.
Really? How so?
Think about how an AOL walled garden actually worked. It was great as long as you never wanted to leave AOL.
Right, you were stuck in their ecosystem.
Exactly. A bank-issued stablecoin is a closed loop. If JP Morgan issues a token, it is highly optimized for the JP Morgan ecosystem.
Okay.
But the modern digital economy requires open, multi-chain interoperability. Developers who are building decentralized applications, they do not want a siloed proprietary bank token.
They want flexibility.
They need the open internet. And Circle provides that open standard across Base, Solana, and Ethereum.
I see.
The switching costs for a developer to abandon an open, interoperable standard and integrate a closed bank system, they're just way too high.
And you mentioned interoperability, and we are already seeing some massive traditional players recognizing that open standard.
So MasterCard.
Exactly, MasterCard. They just expanded their stablecoin settlement support to directly include USDC.
Which is huge.
And Coinbase's new institutional credit strategy, known as CUSHY, it relies entirely on public chain settlement layers where USDC dominates.
Not to mention the entirely new frontier they're pioneering right now, which traditional banks aren't even touching yet.
You're talking about AI.
AI infrastructure for the agentic economy.
Yeah, and the agentic economy is one of those terms that sounds like pure science fiction until you see the actual mechanics.
It really does sound sci-fi.
But when we say agentic economy, I want you to picture an AI assistant that you've tasked with booking a complex travel itinerary. That AI might need to instantly pay a fraction of a cent to an airline's API just to fetch live seat data.
Yeah.
Traditional credit card rails or bank wires, they just cannot process a transaction that small or that fast.
Exactly. We are talking about machine-to-machine micropayments executing in milliseconds.
It's a completely different paradigm.
And right now, there is zero prior revenue from this segment for Circle. It's completely untapped.
Zero. Wow.
But they are building the infrastructure right now so that when AI agents need a native currency to transact with each other, they use USDC.
So if these fundamentals are as strong as the data suggests, there has to be a catalyst that snaps the market out of its current disbelief phase, right?
Absolutely.
That brings us to the catalyst timeline.
The most immediate event on the horizon is the late August 2026 earnings report.
Okay.
This is what could actually move this stock out of its current 30% slump over the next 3 months.
And the street is going to be hyper-focused on two specific metrics in that report.
What are they watching?
First, USDC supply growth, and second, the net interest income, or NII, generated on those reserves.
Right, which we talked about earlier.
Exactly. We just talked about how they make money on the float. If we see a reacceleration in the total supply of USDC being minted, it means their interest-earning asset base is growing.
Makes sense.
And if that happens, an earnings beat is highly probable.
Then you also have the product launches.
Oh, right, the AI side.
Yeah, the rollout of Circle's AI infrastructure products is happening in this exact same window.
That's a powerful combo.
It is. If we see major enterprise clients successfully deploying USDC for these AI microtransactions, it completely rewrites the narrative.
It changes everything.
It proves to Wall Street that the utility of this network goes far beyond just crypto trading and into the core operations of the future internet.
And we absolutely cannot ignore the macro and regulatory timeline here either.
No, we really can't.
The market is closely watching for progress on two key pieces of legislation right now, the Genius Act and the Clarity Act.
Which are massive. If there is a successful Senate vote or, even just committee advancement on these bills, it completely changes the game.
Let's explain why that actually matters to you listening, because, let's be honest, regulatory news can sound incredibly dry.
It can be a little sleep-inducing, yeah.
Right. But right now, Circle plays by the rules. They hold transparent, dollar-for-dollar reserves in the U.S. financial system.
They're fully compliant.
Exactly. But they compete globally against offshore, unregulated rivals like Tether, who just don't have the same compliance costs.
Right, which gives Tether an unfair advantage in some ways.
Exactly. So the Genius and Clarity Acts would essentially establish federal guidelines for stablecoins in the U.S.
Leveling the playing field.
More than leveling it, it legally enshrines Circle's competitive advantage and effectively builds a regulatory fortress around them.
Oh, wow.
Yeah, making it nearly impossible for non-compliant offshore tokens to operate in U.S. institutional markets.
That is a massive protective moat. And when you combine that impending regulatory clarity with the raw adoption numbers we discussed, you have to look at how the stock is actually trading.
Right.
Now let's pivot to the chart.
As we touched on the very beginning, the stock is down 30% from its prior highs.
Yep.
That is a deep, painful psychological reset. When an asset drops that hard, downside resistance gets heavily, heavily tested.
People panic.
Exactly. You have retail investors capitulating. Equity momentum is undeniably heavily bearish right now.
It is. But the internal setup, it's really a coiled spring.
How so?
Yes, if you just glance at the daily candles, the equity chart looks ugly. But the underlying volume and flow data is highly polarized.
Okay, what's the data showing?
While retail equity momentum is bearish, the broader market flow shows intense, aggressive institutional buying into tokenized assets.
And you can literally track that divergence.
You really can.
You see the institutional flow with the Coinbase COSHY integration. You see it with massive capital flowing into Athena's integrations. What the chart is telling us is that sideline institutional capital is basically just sitting there, piling up, waiting for one of those macro legislative catalysts to confidently re-enter the equity side of the trade.
Which creates a really fascinating dynamic in how the broader market is actually talking about the company right now.
It does.
So what does market sentiment look like?
Well, it is a genuine battleground.
Truly.
If you look at the financial media, the bearish side is incredibly loud. You have headlines out there literally asking, quote, why Circle could fall 51%.
Ouch.
Yeah, the fear is centered entirely around that bank competition we debated earlier and, of course, deep concerns over the company's valuation.
Right.
There is this prevailing bear narrative circulating right now that crypto whales are fleeing the ecosystem because, quote, crypto trades stocks while banks issue stablecoins.
But if you actually look under the surface of those loud headlines,
Yeah.
the smart money sentiment is quietly pivoting.
Oh, absolutely.
We mentioned the MasterCard integration earlier,
Yeah.
and that is a massive fundamental win that completely contradicts the bare thesis that traditional finance will just bypass Circle.
It directly refutes it.
Right. And we're even seeing prominent Seeking Alpha contributors publishing these deep, strong buy thesis reports.
Yeah, I saw those.
They're projecting a $2 trillion stablecoin market cap over the next few years, and they're declaring Circle the clear, undisputed winner of that entire sector.
And then, of course, there is the wild card, the M&A rumors.
Oh, right. Mergers and acquisitions.
Yeah. These are unconfirmed and totally speculative, sure, but mechanically they make a lot of logical sense.
I do.
As traditional banks try to enter this space, they are very quickly realizing how technologically and legally difficult it is to build an open network compliant stablecoin from scratch.
It's a massive headache for them.
Exactly. So the rumor mill suggests Circle is a prime acquisition target. Why spend billions of dollars and years of time building a compliant network when you can just buy the regulated leader?
It makes perfect sense. But, even with acquisition rumors and all this fundamental growth, no investment is bulletproof.
No, never.
We have to address the bear case head on. Now let's talk about the risks.
The two biggest threats to this thesis, the things that could absolutely derail a portfolio, are valuation multiples and interest rate dependency.
Let's get into it.
Let's start with valuation, because this is a massive risk. The stock is currently sitting at a 37 times EV to EBITDA multiple.
Which is steep.
Extremely steep. For anyone unfamiliar, enterprise value to EBITDA essentially tells you how many years of current cash flow it would take to buy the entire business.
Right.
So a multiple of 37 means the stock is priced for absolute perfection. The market is pricing in massive, uninterrupted future growth.
And if they miss?
If there is any stumble, any delay in AI adoption, or, say, if the Clarity Act gets stalled in Congress, that 37 times multiple can compress violently.
It drops fast.
The business might still be growing perfectly fine, but if the multiple drops to, say, 15, the stock price gets absolutely crushed.
Which ties directly into the second major risk, which is treasury yield dependency.
This is the big one.
Right. We established earlier that their primary revenue engine is the interest generated on those billions of dollars in USDC reserves.
Yep.
So what happens if short-term U.S. Treasury yields take a sudden sharp dive?
That's the billion-dollar question.
If the Federal Reserve slashes rates, the yield on Circle's massive reserve pile drops, which could severely compress their profit margins literally overnight.
And we cannot simply dismiss the competition aspect either.
No, we can't.
We used the AOL analogy earlier to defend Circle, but major city analysts just recently published a report suggesting that bank token turnover could actually overtake public stablecoin volumes by 2030.
Okay, so they see the banks winning.
Yeah. If those closed-loop, walled gardens somehow become the dominant preferred standard for institutional trading, Circle's open network could be entirely sidelined.
It's a valid point. The yield risk is the most pressing, though, but I think it is really important to note how Circle is actively mitigating it.
How are they doing that?
They aren't just blindly holding static treasuries. They are shifting heavily toward dynamic, ETF-based reserve products.
Interesting.
For example, look at their heavy utilization of the ProShares Genius Money Market ETF, ticker symbol IQMM.
Okay.
It carries a 3.48% 30-day SEC yield, but critically, it holds 100% daily liquid assets.
So it's very nimble.
Exactly. By utilizing active products like this, Circle can dynamically optimize their yield and protect their margins, even if broader macroeconomic interest rates start to fluctuate. They are actively managing that duration risk.
So with everything on the table, what's the final verdict?
Based on the underlying momentum, the massive volume, and the structural regulatory advantages, we're looking at a bullish score of 8 out of 10.
Okay, 8 out of 10.
The target horizon here is a 12 to 18-month hold.
You need that duration.
Yeah, you need that multi-year time frame to look past the current chart volatility and actually capture the upcoming legislative cycle of the Genius and Clarity Acts, as well as the broader macro expansion of tokenized credit.
I tend to agree with that. Despite the painful 30% repricing we've seen recently, And despite carrying that hefty 37 times multiple that really leaves zero room for error, Circle remains the undisputed, heavily regulated leader in a rapidly expanding space.
Exactly. When you see integrations with behemoths like MasterCard,
Hmm.
and when you see the deliberate push into AI machine-machine micropayments, it proves one vital thing.
What's that?
Traditional finance and cutting-edge tech are building on USDC. They aren't trying to bypass it.
Right.
This presents a very rare opportunity to gain targeted equity exposure to the foundational gateway of global credit tokenization.
And it really all comes back to that initial disconnect we talked about. Looking at Circle right now is a lot like looking at Amazon in 2001.
Oh, that's a great comparison.
Right. The stock chart looks like a disaster, it's down heavily, and it is easily scaring away the casual tourist who only looks at the price action.
They see the red and run.
Exactly. But if you look under the hood at the underlying mechanics, the $33 trillion in network volume, the massive institutional adoption, the actual rails being laid for AI, the infrastructure they are building is quietly preparing to take over the financial internet.
You just have to ask yourself a simple question.
Which is, are you trading the fear of this current quarter, or are you investing in the financial settlement infrastructure of the next decade? If you want to build a cleaner stock research workflow, you can check out stockanalysis.com Pro through the link below in the description. Use code ITP for 10% off. Pro comes down to about $5.93 per month when billed annually after the discount, and Unlimited comes down to about $14.93 per month when billed annually after the discount. Remember, stockanalysis.com is a research tool, not financial advice. It does not guarantee investment results, and you should always do your own research before making any investment decision. This is an affiliate link, and we may earn a commission at no extra cost to you.
And if this episode helped you, please subscribe, like, and comment underneath. We'll see you in the next Smart Wealth with Joshua episode.